Hello, I'm Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. This is a special year for investment companies as it marks 150 years since the launch of the first investment company, Foreign and Colonial Investment Trust, in 1868. Investment companies' strong long-term performance and pioneering spirit have been helping investors reach their financial goals for 150 years. Whilst it hasn't always been easy, investment companies' durability has enabled them to navigate many difficult times. We often talk about long-term investing, and it really doesn't get more long-term than this. I'm delighted to be joined by the managers of the three oldest investment companies: Paul Niven, Fund Manager of Foreign and Colonial Investment Trust; Ben Ritchie, Lead Manager of Dunedin Income Growth Investment Trust; and James Dow, Co-Manager of Scottish American. Right, Paul, your company is 150 years old. Why is it still relevant for today's investors?
Well, when we started out in 1868, we intended to give the investor of moderate means access to the same opportunities as large capitalists. And essentially, catering for the everyday saver is something that's been consistent through the last 150 years. So we today look to provide a one-stop shop for growth assets for retail investors, and in fact more than 90% of our shareholders are retail. So we think we're as relevant today as when we were launched 150 years ago.
I'm sure you are. Ben, your company is 145 years old, Dunedin. Why are you still relevant for investors today?
Well, I think the things that we're focusing on today will be relevant in 150 years' time, just as they were relevant 150 years ago, which is growth in income and capital. I think as long as people require income to pay for their needs and everyday requirements, then there's going to be a need for that. And as long as we have inflation in the world, then people are going to want to protect against that. So a portfolio that can deliver both income and capital growth over the long term, I think is going to be well suited to people's needs for the very long term in the future.
Right, James, your company is 144 years old. Really has, golden era of investment companies here today. Why are you still relevant for investors today?
Well, Scottish American, or Saints as we're often called, has two core aims to what it's trying to do. One is to deliver a dependable income stream that our shareholders can rely on through thick and thin, through good times and bad, that the income will still be maintained. And the second objective is to grow that income and grow capital over time ahead of inflation. And if you think of, as we sit here today, the number of people who, for example, in retirement are looking for a really steady, dependable income that will grow over time, that number of people is only growing. If you think of the freedoms that we now have, post-annuities, to invest however we please, again, that makes Scottish American and those aims of dependable income and growth as relevant today as they've ever been.
Yeah, so we've got more investors investing for a longer time.
Yes, exactly.
Now, you're clearly all long-term investors. Paul, how do you approach your long-term investment strategy? How do you deliver those long-term returns?
Well, our approach is to provide a diversified opportunity set in public markets and private markets. So we're invested in listed equities predominantly, but also some private market exposure. And we invest into a range of different strategies and mandates, some of which are managed by the asset management group BMO, and some of which we manage from outside the organisation, by blending together a range of diversified strategies, for example, growth investing in the US and value investing, as well as other strategies. We're able to add returns to the portfolio while reducing risk. So that essentially enables us to provide a smoother return journey for our shareholders.
Right, and Ben, what's your strategy for delivering long-term returns to investors?
Well, we're very focused on investing in high-quality businesses and looking to pay a price for those that can imply good returns above that you'd expect from the stock market over the longer term. And we certainly want a portion of that to come through dividends, but also importantly through dividend growth. Within our income generation, we also have a portfolio of bonds which generate between 6 and 7% of our income, and we also generate 7 to 8% per annum from our option writing strategy. So the core is being delivered from a portfolio predominantly of UK equities, but we can invest up to 20% overseas, topped up with some option income and also some credit income as well.
Thanks. And James, what's your strategy to deliver long-term returns?
Well, we have quite a simple philosophy, quite a long-standing philosophy, and that is to deliver the dependable income and the growth that we aspire to. We simply look for companies that we expect to do the same thing, that will pay dependable dividends and that will grow over time. So we have a global universe, 2,500 companies, and we simply scour that universe to find diversified portfolio of about 60 to 80 names which will meet that objective of a resilient income stream and growth over time.
Well, it's interesting you talk about income. Income's clearly an important part of your returns. How do you go about delivering that income strategy?
Well, we put a lot of emphasis on, for example, that point about dependability. So we have quite a disciplined process that walks us through questions about things like balance sheets, cash flow generation, and we try to think long-term about long-term income generation, not just short-term yield. So we think about what will happen the next time we have a financial crisis or a big economic slowdown, and how resilient might the dividend be of an investment through that period. And by thinking about all those things in advance and putting them together in the portfolio, we expect that our own distribution to shareholders, our own income stream, will also be resilient and grow over time.
Right, and Ben, you're clearly, income's important for you too. What's your strategy to deliver strong returns and strong income over the long term?
Well, again, I think it's about getting the companies right. If we can find the strong business models with good long-term growth prospects, good balance sheets, good cash generation, good management, and good governance, and we can put that all together, then we'll find businesses which ultimately can not only deliver good income to us, but also can grow that over the longer term. And that's very much our sort of bottom-up stock-picking approach with a long-term overlay and looking to have a fairly focused portfolio. An income strategy for us might have a slightly more names in it than our normal fund, partly in order to deliver both the high yield and also the growth, but we should be looking for a fairly concentrated portfolio as well to deliver that.
Thank you. And Paul, clearly income is a part of your return, but perhaps not so important as these other companies here.
Sure, so we look to deliver long-term growth in capital and income is very, very important for our shareholders. We've paid a dividend in each of the last 150 years and a rising dividend for the last 47. So we have an expectation, our shareholders have an expectation not only to pay a dividend, but to grow that through time. But we are not a high-yielding investment trust, and we look to balance the need for capital growth and income by blending. We have a growth strategy specifically designed to supplement some of those lower yielding areas like US growth stocks, for example. So again, a range of different investment strategies, of which an explicit growth strategy, an explicit income strategy is one.
Right. Now, clearly we've seen volatility return after what's been a great run for markets. What's your outlook for markets, Ben?
Well, we'd welcome more volatility. I think as bottom-up stock pickers, we like the opportunity not only to be able to find good companies at more attractive valuations, but also we think our portfolio with its higher quality focus should be more resilient, perhaps than our competitors, certainly than the market over the medium term if we were to see prolonged volatility. So we would welcome that if it comes back. I think, to be honest, at the moment we've got a dichotomy. We've got rising interest rates, but we've also got better global growth, and I think it's the wrestle between how those two things play out over time. Personally, I feel quite confident that the kind of high quality, long-term compounding businesses that we own will actually do quite fine, although there may be a little bit of valuation derating to come through as a result of higher interest rates, but also higher global growth is also going to be better for profits. And companies with strong pricing power should also be able to increase revenues ahead of inflation.
Right, and James, obviously volatility is back on the agenda. What's your outlook for markets?
Well, we're perhaps a little bit unusual because we don't spend a great deal of time trying to forecast short-term volatility or market moves. What we're instead focused on is bottom-up, finding companies that, regardless of what the macro environment might be or how volatile markets might be, will continue to do well, will continue to grow their dividends, will continue to grow their earnings. So that focus, that longer-term focus, I think, is one reason why the trust has been able to maintain that very long dividend record. The last cut was in 1938, the last time Saints cut its dividend.
Ago.
So, and it's very much been driven by that focus on companies that, whatever the weather, if you like, will do well through those macro or market environments.
Great. And Paul, what's your outlook for markets, considering we've had a bit of volatility now in February?
Sure, well, I would echo the other comments. I think it's absolutely right to look for sustainable cash flow generation in terms of underlying individual stocks. But I think the bull market is mature. Rising volatility is to be expected. But the good news is that the growth is robust. Earnings are robust. and that should underpin market fundamentals. So we think that on the one hand, as we've heard, the interest rates are going up, but that is more likely to be countered by actually improving fundamentals. So bull market is mature, but we don't think it's over yet.
Right, now clearly your company's been around a long time. You know, you've navigated difficult times, you know, and clearly, you know, world wars, financial crisis more recently, but tech boom and bust, a lot of difficult times. What has helped you achieve this? James?
One of the most helpful things, I think, for Scottish American, for Saints, has been the revenue reserve, the ability to save some of the income we've earned in previous years, so that when we have extreme times and when there's extreme pressure on companies, we can supplement the income received from the investments we make, if necessary, from the reserves. And that helps smooth the income, and that's one reason, again, why you see that long record of dividend payments from Saints. I think the other thing that helps is probably the board of the company as well, that it challenges us as managers to make sure that we're keeping on the right path, that we're focused on those outcomes of the dependability of the income, the growth over time. And in times of stress or times of difficult financial market dislocations, they've been very helpful in keeping us focused on what we need to do to be able to extend that record with Saints.
Yes, you've just highlighted two real benefits of the investment company structure.
Yes, that's right,
there.
yeah.
Ben, how have you achieved a successful outcome during navigating difficult times?
Well, I think I very much echo what James has just said there. I think that the sort of 37 years without cutting a dividend for Digit, perhaps not quite as long as some trusts, but still a very respectable position to be in. And I think, again, that's been underpinned by revenue reserves. I think it's been underpinned by that strong independent board. Returns have been enhanced through the use of modest, conservatively deployed leverage. I think relatively modest fees compared to a lot of open-ended products all help to improve the overall return to investors. And I think it's also about knowing when the right time is to make strategic changes within the portfolio and within the structure of the company, that it's the right time to maybe look to issue long-term debt, to look more to credit, or potentially change the asset class within the company. Those are the kind of key decisions that ultimately can make big differences to investors over the long term.
Absolutely. I think the investment company sector is incredibly innovative and does make these changes when necessary. Paul, obviously you're the manager of the oldest investment company. Clearly, you know, you must have got through the tough times. What's helped you achieve that?
Well, I think the capital structure certainly is hugely advantageous for investment companies, having that closed-ended structure, revenue reserves. That really helps in terms of being able to take a long-term view and to provision for the less good times in terms of dividends. But I think the key really is innovation through time. One needs to adapt and change through time. And I think all of us here, the investment companies which we manage have evolved and changed to ensure that they're fit for purpose. So starting off as an emerging market debt fund 150 years ago, then investing into equities in the 1920s, and today a global growth fund, one-stop shop for investors. So adapting and changing to the times, I think, is the single most important lesson, along with diversification. A diversified approach to ensure that your portfolio is robust to withstand the stresses which inevitably will come along from time to time.
Yeah, they really all have adapted and innovated to meet investors' needs and financial requirements. That's very clear, and that's clearly why you're all still here and still very relevant. I'd like to thank our managers very much for joining us today. After 150 years, the investment company industry is in good health, and we're looking forward to the next 150 years. It's interesting to hear the managers' views, but I'd like to emphasise that we don't have a crystal ball and we don't know what's going to happen in the future. Investment is for the long term, and you need to have a well-balanced portfolio. If you're in any doubt, you should talk to a financial advisor. Thank you so much for watching.